Morning and welcome to Money Control. Well, the big news that has come in this morning is India's inclusion in the JPMorgan Global Bond Index. What does this mean? Well, simply put, all of us understand equity markets and index funds. Just like when a stock enters an index, a whole bunch of index funds tracking that index realign their portfolios to put in more capital into the new entrant, and therefore that stock gets a lot of money and there is momentum built into that stock. Exactly the same thing happens with bond markets also. When a new country enters the index, obviously the passive money or the index funds that are tracking that index will reallocate funds or put in fresh capital into the new entrant, and that will trigger inflows into that country's bonds. This is exactly what is going to happen as India enters into the global bond index formulated by JP Morgan. That's the news this morning. How does this impact our bond markets? Because it will obviously have implications for interest rates and bond prices. How does this impact India's overall macroeconomics? How does this impact the global money flows into the country? To understand all of this, I have with me CIO of Kotak AMC, Deepak Agrawal. Deepak, thank you so much for joining this morning. Big news. Looking at the bond market reaction and the currency market reaction, it looks like some part of this good news that we've been waiting for over the past 2 years at least was already discounted. What is your take?
Good morning, Mahalakshmi. Yes, see, over the course of last 3 weeks, we have seen US bond yield spiking by close to 30 basis points from 420 to 4.5%. At the same time, we have seen Brent prices spiking from close to $87-88 per barrel, went up to $95 per barrel. But our bond yields were more or less trading in the band of 715 to 720. So market was expecting inclusion into bond index, which prevented the spike in bond yields in spite of spike in global bond yields. And therefore, yes, market was already pricing in. Today morning, again, the bond markets opened at 707. The 10-year bond, which yesterday closed at around 714, opened 7 basis point lower at around 707, and currently trading at around 712.
Yeah, and what is your own reading? Because markets are a forward discounting mechanism, and there are obviously multiple factors that play in determining interest rates. How do you see this going over the next 3 months, and what is the outlook on interest rates for the rest of the year?
See, basically, right now there are global headwinds. The global bond yields are rising, and crude oil price is also moving up, and there are speculations or talk about crude moving up to $100 per barrel. But let's look at this news. This is a very big positive news. India gets a 10% weightage in the JP Morgan bond index. The size of the JP Morgan bond index is close to $240 billion. So this will get close to $24 billion flows next year. Now, there are guys who don't follow GP bond index. They could also, like sovereign wealth funds, could also invest close to $6 to $7 billion next year. This can also lead to inclusion of Indian bonds into Bloomberg Global Bond Aggregate Bond Index, which can also get in $10 billion. So next year, we could see close to $30 to $35 billion inflow. So this is a very big positive. Plus, let's say once the index flow is out annually, also we would get close to $10 to $15 billion of inflow into Indian bond market. So yes, right now there are global headwinds, and therefore probably the market reaction, because market had already discounted this news, we have seen close to 3 to 5 basis point drop in yields. And plus, this news will continue to linger. So let's say even if we see spike in global bond yields or we spike in crude oil prices, probably the rise in Indian bond yields will be relatively muted. And in the near term, we expect the 10-year bond to trade in the band of 7 to 7.25. Now, over a period of time, if global headwinds reduce, Brent price also correct, then probably it's a possibility that 10-year can breach 7%. But for now, we expect 10-year to trade in the band of 7 to 7.25.
Okay, so JP Morgan, based on the passive flows itself, we are seeing about $21 billion of flows in the 10 months following the change that happens in June next year. you are saying that there could be an additional flow of about $10 billion because more active funds could also look at allocating to India, and the possibility of, other indices also, revisiting their theory on India and trying to include India into their respective bond indices. I guess the FTSE and the Bloomberg index, etc., is being talked about. So the question is, so you're suggesting about $30 billion of flows on an ongoing basis from next year onwards. What does this mean for our overall, external account and macroeconomics? And what does it mean for the currency?
See, it's a big positive for our macro, and basically, again, it's reinforcing the strength of our economy. So what we are saying immediately, because of the inclusion, we'll get 24 to 30 billion dollars inflow. Plus, let's say on an annual basis, on a recurring basis, probably we should get 15 to billion dollars flow every year, because there will be multiple sovereign funds. They will be looking to allocate to India post the inclusion in Indian bond index, even though probably they are not following JP bond index. So the annual flow should also increase. Now, this year, recently we have seen strength in dollar index. We have seen spike in Brent prices, and dollar rupee has seen depreciation. Yes, today dollar rupee has appreciated from 83.35 levels to sub 83 levels. We believe that RBI has been managing rupee volatility very well. For the current year, we expect a current account surplus of close to current account deficit of close to $55 billion and a BOP surplus of $17 billion. Next year, even if probably, let's say, the current account deficit widens a little bit, but these flows will help RBI manage the rupee volatility very well. And let's say for dollar rupee, in the near term, we expect dollar rupee to trade in the band of 80 to 50 to 84.
Sorry, in the near term, you expect, can you repeat that, please?
In the near term, we expect dollar rupee to trade in the band of 80 to 50 to 84.
Okay.
In the band.
And yeah. And what would you project as the best case and worst case for the rupee for the rest of the year? And what kind of assumptions will you go with?
See, again, for rupee, I think we are very well placed this year as well. The current account deficit is close to $55 billion, and we are projecting a balance of payment surplus of anywhere between $15 to $20 billion. So this year also, and plus this news will also play in market. We could see some buying in anticipation of inclusion. So part of, or probably 20% of the next year inflow, we should see in over the course of next 4 to 5 months, which should also help rupee be in the band of 80 to 50 to 84. So from here till March 2024, we broadly expect rupee to trade in the band of 80 to 50 to 84.
Okay. And, does this, Deepak, relay the, does this make foreign investors reevaluate what they should assume as the, as the fluctuation in the rupee? Usually, on an annual basis, when equity money also comes into India, they're constantly assuming a 3-4% minimum depreciation in the rupee. That's part of the equation. Now, how much does this move really alter those assumptions?
See, at least next year, a $30 billion flow is a very substantial flow. And it will, even if probably current account deficit widen a little bit, we'll have a balance of payment surplus. Plus, minus this flow also, we have close to $600 billion reserves. And RBI has been managing volatility very well. This additional $30 billion inflow will add to our forex reserves and will give flexibility to RBI to manage the volatility in currency very well. And therefore, yes, probably if the investors were pricing in steep depreciation, probably their expectation can be reduced post this news.
Okay. And in terms of rates, Deepak, what is your view? Because it seems like the inflation, the risk of inflation going up a little higher seems likely in the US, and the Fed seems to be a little more cautious than they were perhaps even a quarter ago. We were thinking that the worst is behind us and it has really peaked out, but now there is greater part of the market thinks that maybe one more rate hike may happen, if at all, and it might stay elevated for a longer period. What is your own take on that? And does that, does this move signal what kind of differential can India really maintain, from here on?
See, two things. One, with respect to inflation, yes, we had a higher inflation for the month of July and August. The August inflation number came at 680. But if you look at inflation number excluding veggies, the inflation was at 5.5%. Now the market is expecting, and the vegetable prices have cooled off, and the September inflation is likely to be in the band of 5.25 to 5.5%, and the inflation in second half is also likely to be in the band of 5 to 5.25. So broadly, we don't expect RBI. Yes, interest rate differential have narrowed, but finally our monetary policy will be decided by our inflation projections, and inflation is likely to be in a band of 5 to 5.25. And let's say average inflation for FY24 closer to 540, 550. So at 6.5%, where RBI is keeping liquidity tight and operating rate at 675, we have a real rates of close to 100 to 125 basis point. So we don't expect RBI to raise rates in order to basically, in spite of narrowing interest rate differential. Number one. Number two, with respect to US, yes, the core inflation is likely to trend lower in US down to 4%. Therefore, we don't expect Fed to raise rates. Yes, Fed may continue to remain higher for longer, and it has resulted in spike in global bond yields. And therefore, for now, let's say we don't expect any further hikes by Fed. Coming back here, yes, as over the course of last 3 weeks, we have seen spike in global bond yields. We have seen Brent prices rising. These headwinds may continue, which may result in 10-year bond yield, which is currently trading at around 712. It can spike, but this news that FIIs are likely to buy starting next year, or probably some hedge funds may prepone their purchases, this will put a cap on long-term bond yields, and therefore we believe that in the near term, from here till March 24, probably 10-year bond is trading in the band of 7 to 7.25.
Sure. So in the past 1 year, Deepak, the ongoing trend has been that, as rates got higher and higher, both in India and abroad, the high net worth individuals, savvy investors have, the allocation to fixed income has really gone up. Today, looking at where we are in India, do you think we have hit the peak, and this is the time, if at all you want to take exposure to fixed income, this is the time to lock up rates and stash your money into fixed income?
Yes, we have been advising investors to increase duration of their portfolio. We believe we are close to the peak of interest rate cycle, both globally and domestically. And we have been advising investors to increase duration. By increasing duration, one, you reduce the reinvestment risk, and second, that if yields do trend lower, there are potentials for capital gain, making the total return from a fixed income product higher than traditional fixed income options. And we would post this is a positive news. Yes, in the near term, due to global bond yields and due to crude oil prices, probably the rise may be muted, but we believe that over medium term, yields will trend lower.
Fair enough. And what is the duration that you are running in your own, debt fund portfolios, and what is the industry average now?
See, again, it is category to category. Our sense is that the short duration funds, which are managed in the band of 1 to 3 year duration, currently the industry duration may be close to 2.5 years, which is closer to the higher end of the band.
Right.
The one short-term category, banking PSU category, these categories are running a duration in the band of 2.25 years to 2.5 years. And the dynamic bond fund category, where the fund manager has the flexibility to manage the duration, these funds are largely managing the duration in the band of, let's say, 4 to 5 years. Similarly, gilt and bond schemes, with the schemes where the scheme has the flexibility to invest in 6 year, 7 year duration, these funds are also being managed in the band of 5 to 6 year duration at the current juncture.
So today, if as an investor you were to, look at, debt funds versus fixed deposits, you think we are at a time that the total return on debt funds could be better because you could be looking at capital appreciation, right? You hinted something like that.
Yeah. So we believe that one, See again, through fixed income portfolios, you can lock in your money for a longer duration. Second thing, we believe that the yield curve is inverted in fixed deposit. So we are advising investors to increase duration for one, you reduce the reinvestment risk, plus due to drop in bond yields over the course of let's say again next year, we believe that probably RBI probably in the second half of calendar year 2024, we continue to expect RBI to reduce rates by 50 basis point, and therefore there are potentials for capital gain. Plus, this bond inclusion is an additional positive. So, whenever the global headwind reduce, whenever global bond yields subside and we see drop in crude oil prices, we can see a drop in Indian bond yields as well.
Sure. And for the benefit of some of our corporate viewers and even stock market investors, how do you see this impacting the borrowing cost for companies, or is that stretching a step too far?
See again, finally, the corporate, let's say in capital market, the corporate bond borrowing is also linked to Government of India borrowing cost. So this is a positive news inclusion. We will get next year close to $35 billion flows, and on a recurring basis, probably we'll get $10 to $15 billion flows. So this is a positive news. The government of India should be able to conduct its borrowing program smoothly. It should put a cap on yields in the near term, and finally, it will also help in bringing down the overall interest rates in the economy.
Sure. And in terms of external borrowing, does this really help? Because in the absence of a rating upgrade, is there a possibility of borrowing costs coming down for corporates?
Yes. So again, this coupled with upgrade in India's rating will surely be a positive, and will help in bringing down the Indian bond yields. But let's say again, this news was discounted. Today, markets have reacted positively. We have seen close to 3 to 5 basis point drop in yields, and in the near term, because of the rise in global bond yields, because of the near term uncertainty with respect to crude oil price movement, we believe in the near term the 10-year bond should trade in the band of 7 to 7.25.
Sure. That's all the questions I have, Deepak. Thank you so much for joining this morning.
My pleasure. Thank you.